Good afternoon, good morning, or good evening from whichever part of the world you may be tuning in for this MEED live webinar on oil and gas projects in the MENA region. My name is Indrajit Sen, and I have the pleasure of welcoming you to this live webinar as your host and presenter. To introduce myself, I'm the oil and gas editor at MEED. I have been covering the oil and gas industry broadly for about a decade or so. And half a dozen years with MEED now. And what a time actually to be discussing oil and gas projects and investments really. The regional industry is witnessing a wave of capital expenditure and projects owing largely to the high oil price movement this year. The last time I checked today, I think Brent crude was trading at over $85 a barrel. Prolific period in the industry, really. So over the next hour or so, I will try to provide a summary of the MENA oil and gas and petrochemicals projects market, offer a glimpse of the main mega projects, including the main project programs, analyze active contracts and spending to date, and highlight key contracts to be tendered and awarded over the next 18 months or so. Now, before we begin, let me talk a bit about MEED and what we do here in this wonderful organization. So we are owned by London headquartered Global Data PLC. Global Data is our parent company. But MEED was established more than 6 decades ago in 1957. And we have been covering and tracking projects across the main industrial sectors in the Middle East and North Africa region, including, of course, oil and gas, construction, of course, the biggest market in this part of the world, power, water, infrastructure, you name it. We have been doing this before anyone else and probably better than anyone else. And obviously, we continue to provide market intelligence, help you make more informed decisions about your projects and the kind of business you should be pursuing and things like that. Now, before we dive straight into the webinar, I would like to draw your attention to the launch of our new comprehensive report on MENA oil and gas for the 2023-24 period. It is an exhaustive research work on the oil and gas and petrochemicals market in the MENA region, and it is prepared by a team of analysts belonging to both MEED and Global Data. So do make sure to grab a copy of this report to help yourself understand the project's landscape, direction, and focus of client investments to be able to make more informed decisions. And also, if you purchase using the code mentioned in the slide, you also get an additional $100 discount. So try and make use of that opportunity. And yes, this is just the report you need. Okay. Without further ado, let's dive into the presentation. Now, the past always helps us understand our present and determine the course of the future. So let's look at where the market stands at this point in time. Now, as you can see from the chart over here, Saudi Arabia is obviously has the largest share of all active oil, gas, and chemical projects, driven largely by Saudi Aramco and SABIC. And following the integration of these two giant companies in the kingdom in 2020, obviously the combined entity is driving project investments in the kingdom. Egypt is, unsurprisingly, the largest market in North Africa and the Maghreb region. A lot of petrochemical projects have been announced in the past couple of years. Although, given the economic situation in the country and the instability surrounding the Egyptian pound and the high inflation that Egypt is going through at the moment, the future of a lot of those projects lie in doldrums. Obviously, the government is pushing very hard to get some of those important projects underway. When it comes to the GCC, the UAE and Qatar are the second and third largest markets. Obviously, given the kind of push that the governments and the national oil companies are driving to sort of sort of increase the capacity in oil and gas production, but also transition into newer forms of energy. Now let's look at the a layer beneath the overall projects market, and it'll be good to make a comparison of both projects under execution and the projects in pre-execution stages. Now, when it comes to under execution, obviously, as we can see from the chart, that the value of oil projects under execution is considerably larger than projects under execution in the gas and chemical sectors. And that is the way it has always been. 38% in oil compared to 34% in gas and 28% in chemicals. But when it comes to planned projects, so projects in various pre-execution stages like pre-FEED, FEED, main contract pre-qualification, bid evaluation, the picture changes slightly, well, considerably actually. The value of gas projects emerges as the largest segment. Again, 33%. Chemicals follows closely at second, I mean, almost neck and neck. And this indicates sort of the changing capex trends. Now, rising investment in gas projects in future comes as these international oil companies and national oil companies, the likes of Saudi Aramco, Qatar Energy, ADNOC, shift their portfolios towards gas production, which is seen as obviously as a energy transition fuel, and in the short term, or at least the short to mid term, as a cleaner alternative to oil. Thank you, by the way, for turning up in huge numbers. You can see almost close to 400 people tuning into this webinar. So thank you very much for taking time out. Now, as I was saying, boosting natural gas supplies and production capacity have become a priority for the governments of the region as they aim to meet domestic demand. Obviously, like I mentioned, gas being conceived as, or rather perceived as, an energy transition fuel. Industries, both oil and non-oil, especially in the power generation sector, are relying a lot on domestic gas production, which is therefore increasing demand for natural gas. And according to our estimates, demand is projected to rise 15% annually, driven largely by the power and the non-oil industrial sectors. Iran, Qatar, Saudi Arabia, the UAE, Egypt, Iraq, Algeria are driving gas project activity. And obviously, I'm referring to the projects in the pre-execution stages, the chart on your right. And also, I mean, taking chemicals into consideration, I think we see one of the biggest opportunities to deliver revenue growth over the next 2 decades comes from the petrochemicals industries, as the oil producers look to derive more value from every barrel of crude they produce. Now, global demand for petrochemicals also, I mean, the demand growth also aligns perfectly with this strategy. I think the projected rise in global demand in petrochemicals is expected at 150% by 2040. The region's national oil companies are also increasing expenditure in petrochemicals production and product diversity. So previously, while petrochemicals production used to be constrained to the main feedstock for derivatives, obviously now the focus of investments is production of derivatives along with the essential feedstocks like propane and ethane and ethylene. Regional producers are also increasing focus on integrating petrochemicals production capacity into existing refinery complexes to drive efficiencies in logistics and supply, and as I mentioned, as well as into greater product flexibility. Now, let's take a look at the rankings of project owners and contractors. This makes for a very interesting analysis. And let's start with the clients, the project owners and operators. Saudi Aramco, unsurprisingly, is ranked in first position, given the large volume of both under execution projects as well as projects it is planned for the next 18 months to 2 years. Obviously, this chart looks at, or rather the rankings are based on projects under execution, projects that have been awarded to EPC contractors and are currently under EPC execution. QatarEnergy, the number for QatarEnergy, might I say at this point, includes the ones for Qatargas and North Oil Company. So that's the combined value for QatarEnergy. They obviously come in the second position, driven again largely by the North Field LNG expansion project. Again, what we've done is, since the shareholding structures of these various operating companies within the ADNOC group tend to be different, we've categorized them separately, but put together, obviously, ADNOC group still sort of ranks in third position if you take the cumulative value of projects under execution into account. A bunch of the Iranian state-owned oil and gas companies feature in this list as well. The Iraqi companies as well, Basra Gas at number 5, South Refineries Company in number 6, and Sonatrach from Algeria at number 7. Now, if you turn our attention to the contractors, obviously, it's the European contractors who continue to dominate the regional EPC market. They have done so for a while now, at least if memory serves me right, for the last 10 years. I think they've consistently won the lion's share of contracts in this part of the world. But what is interesting to note is that the Japanese and South Korean firms have sort of staged a strong comeback. They used to be sort of the prominent players in the late 90s and the early the first decade of the 2000s, and their position in the market sort of withered away due to a change in strategy. But now they are back in the market and back with the force. So you see, obviously, Technip Energies, the value of work that they've won in the last couple of years is astounding. They are involved in both phases of the North Field LNG expansion project in Qatar. Saipem, again, due to the bulk of the offshore work that they are winning in Saudi Aramco. Obviously, that's helped them propel to the second position. Técnicas Reunidas from Spain, obviously in third position as well. Mer Tecnimont from Italy, number 4, and then at number 5 you have JGC Corporation from Japan. The only local contractor in this list of the sort of top 20 oil and gas EPC firms is NPCC of Abu Dhabi. We see that following the integration of NPCC into NMDC a couple of years ago, that has positioned them quite strongly for taking on a lot of work at home. But even if you look at their exposure outside the Abu Dhabi and ADNOC market, they are one of the top 3 contractors when it comes to the Aramco offshore space, consistently winning the CRPO tenders over the last 2 years or so. McDermott International, they have slipped quite a bit, but then continue to win work. Qatar being one of the largest markets for them at this point in time, but they are also vying for a lot of contracts and projects in the UAE and Saudi Arabia. Okay. Let's do a bit of historical analysis. And this is, of course, taking all the data from 2013 until the end of last year. So it doesn't take into account contracts that have been awarded this year in 2023. So when we combine the oil, gas, and petrochemicals market with the other sectors, obviously the energy industry ranks as the second largest after, of course, construction. Now, in the past decade, there have been more than 280 billion worth of contracts that have been awarded in the region, hitting a peak of 47 billion in 2021. Now, that was a record year straight after the peak of the COVID pandemic in 2020. On an annual basis, the market is highly cyclical. For example, in 2021, the record year followed a record low in 2020, just like I mentioned. It's also interesting to see that the market is not necessarily correlated with oil price cycles. That is mainly because the governments here, or rather the main project clients, are focused on long-term vision and achieving those long-term targets rather than investing based on the oil price movements. Oil prices obviously do have an important part to play, but oil prices do not necessarily project investments in like it used to back in the day. Sticking with this slide for now, I think a number of factors have fueled project activity across the region of the past decade. Now, if you look at upstream, especially on the chart on the left, the value of GCC contracts awarded. Upstream investment has been driven by the need to meet rising demand, both at home and abroad, and the need to replace resources lost through natural depletion. A lot of the oil fields that exist in this in the Gulf in particular are maturing, aging assets, which need a lot of spending for them to be able to maintain those productivity levels. The desire to develop income streams other than crude oil exports is seeing the launch of a new generation of downstream projects. We've seen that take place over the past few years and move away from just traditional crude oil and gas refining into petrochemicals. We've seen new greenfield petrochemical facilities and refinery expansions, and also the integration of the two for more feedstock value and greater capital advantage. Now, together, these new strategies will, if you talk about the future, that is, we'll see that these new strategies translate into diversification of national and international oil companies into more diversified energy companies, with activities stretching from oil production and solar energy to technology development and plastics production. Furthermore, as they seek to drive profitability, the diversification drive will also see the vertical integration of previously separate industries, so doing away with those silos, standardization and design simplification, and the introduction of disruptive business models and new technologies. I'll take a pause at this point and take a look at some of the questions that have come through. Okay, let me also mention at this point that the presentation will be made available to all registered attendees of this webinar. It will land in your inbox as soon as the presentation is over. And also a recording of this presentation will be available to you later this week. There's a question from Mark Welton. How have you determined the split of revenue by contractor for projects where contractors have entered into JV or as consortiums? That's a very interesting question. Now, I'll have to be honest, that is something we have had challenge determining, mostly due to the fact that consortiums hardly ever reveal the split of their revenues, but where available, we take that into account. And obviously that gets then reflected into their revenues. There's another question that I want to look at. Do you have data on how many of the new oil and gas projects include carbon capture capacity? If you, and the question is from Katie Watt. So Katie, we do have a separate section on MEED projects, and also if you go onto our news website, meed.com, we try and segment projects based on carbon capture as a separate category, because CCUS is a segment that is essentially transpires a number of different sectors. So I think just like hydrogen, I think that's a better way of dealing with such projects. So if you use the search functions on meed.com, you should on MEED projects as well. You should see a separate tab just to give you a list of CCUS projects. I will come back to questions later, but and I will give way, but let's make some progress with the presentations. I think we've covered the historical analysis quite a lot in detail, but just as a final note, I think in the past 5 years, spending has been dominated by Saudi Arabia, the UAE, Qatar, but then again, spending in some years has been highly cyclical, both as a combination of the oil price movements. 2016 and 2015 were particularly slump years in terms of project investments. And then the COVID pandemic, as you can see from the chart, has played quite an impact on project investments in oil, gas, and petrochemicals in the Gulf. Kuwait invested more than $40 billion in 2013 and 14, but has spent very little since, and that is largely due to the political instability and the gridlock in parliament in that country. Bahrain and Oman are much smaller markets, although in Oman, some of the projects tend to literally dwarf if one takes a snapshot of regional mega projects, and we'll talk about that in detail in just a while. Okay. So here's a chart of oil and gas spending in the GCC, and we are taking GCC as a case study because this is where the bulk of the oil and gas and chemicals project spending takes place. If you look at spending since January of 2021 versus near-term future contracts, by near-term we mean contracts that are due to be awarded in the next 12 to 18 months. The picture is quite self-explanatory, really. It's quite neck and neck in Bahrain. Kuwait, which used to be quite a big spender, is seeing quite a shift in future contract awards. In Qatar, of course, we suspect that the lion's share of contracts that were due to be awarded for the North Field LNG expansion project have already been awarded. And therefore, you see quite that significant drop in future contract awards. However, that is not to mean that the country's energy market will experience a slowdown. Obviously, Qatar Energy will continue to spend on several projects across the board, especially in things like fertilizers. And again, you have to stay tuned to MEED.com for news that we plan to produce the next few weeks on some of those projects that have been allocated to come online later this decade. The Saudi Arabia, the contracts that have been awarded in the last 2 years, so 2021 till the start of this year. I mean, obviously, that is going to be superseded by the value of contracts that are scheduled to be awarded over the next 18 months, and the spending on offshore engineering, procurement, construction, and installation contracts will play a large part in that. But then there are also a number of mega projects, both in the upstream, downstream, and petrochemical sectors that are due to be awarded, and that is playing a huge hand in that value of contracts to be awarded. A similar story in the UAE, although the future contract awards just simply dwarfs the value of contracts that have been awarded since the start of 2021. A bulk, or shall I say a significant part of that future contract awards will be taken up by the Hale and Kasha mega project, and we will talk about that when we get into the mega project section of this webinar. And if you take a look at the cash flow analysis that we've done for you, that obviously tells a more detailed picture of where the money has been spent, where it is continuing to be spent, and what is due to come over the next course of time. Okay, future spending. Obviously, we've touched upon this in the previous slide. The UAE, I'll have to say, simply by virtue of the Hail and Ghasha mega project and the sort of petrochemical projects that have been planned in the Taziz Derivatives Park in Ruwais, Abu Dhabi, combined with the planned LNG project, ADNOC Gas, the projects that have been announced by ADNOC Gas as part of its financial results last month. All of that put together puts the UAE as the #1 market for future project investments, and this is expected to take shape within the next 2 years. And you can see the volume or rather the value of these projects in the UAE, talking about exceeding $90 billion. Saudi Arabia, again, a close second at more than $80 billion, really. Qatar, as explained, will experience sort of a slowdown in spending, but by no account a sort of a lull for a prolonged period. Oman, again, a number of projects. We have the revival, rather, of the Duqm Petrochemicals project. There has been movement in that direction lately. Total Energies has also sort of revised and work on its planned Mars LNG project. A lot of gas development activities also being planned in Oman. So all of that will translate into a robust spending in future. And the chart on the right obviously takes the chart on the left into greater detail. Okay. What is to come? We've talked about the future contract awards for a while now. Here's a list of what we expect could be awarded. I mean, I can see some of that being awarded by the end of this year, and obviously by the second half of next year, all of those projects should have been awarded. I'm sorry, by the end of next year, that is. Topping these selected MENA oil and gas and petrochemical projects, which are currently under the bidding stage. Hail and Ghasha obviously tops the list. There is also that Fujairah LNG project, which has now been relocated to Ruwais, and bids for that have been, the technical bids rather, have been submitted for that. We have the different packages of North Field Production Sustainability project in Qatar. A couple of those, and there are a total of 4 EPCI packages, part of that NFPS mega project. 2 of those have been awarded already. There are 2 more remaining. And as you can see, Scope D is valued at close to $4 billion. Several other projects. We can see that there is the tail gas treatment project of Saudi Aramco. Now, MEED very recently reported that negotiations are continuing on a very intense basis. What is this project? Basically, it involves modifying and upgrading sulfur recovery units at Aramco's gas processing plants. Mainly located in the Eastern Province. There have been 7 plants that have been identified which sort of need tail gas treatment, and this is aligned with Saudi Arabia's 2050 net zero commitment. And under the desulfurization program, Aramco expects third-party investors to build large downstream tail gas treatment units to collect and process tail gas discharge from these SRU, the sulfur recovery units, at those 7 identified plants of Berry, Harad, Hawiya, Karsania, Shedgum, Atmania, and Wasit. And obviously, when these facilities are developed, it'll be the first sort of PPP project in Aramco's main body of the oil and gas business. And it will be the first build, own, and operate, or build, own, operate, transfer sort of arrangement, BOOT basis. And like I said, making it one of the first PPP projects in the traditional oil and gas space. Two consortiums are bidding for this TGT project, and we've reported on negotiations that are currently taking place between Aramco and those two consortiums of contractors. We also see the Melita project in Libya. Obviously, that has been under bidding for some time now, but is seeing some sort of movement. And now, Melita Oil and Gas is obviously owned by ENI of Italy, which owns 50% of the stake, and Libya's national oil company owns the other 50%. And obviously, therefore, due to an increased push from ENI to make progress with this project, we are seeing a lot of activity picking up in this MOG project. There is also the Fadhili gas expansion plant, but we will come back to this at a later stage. For now, let me turn my attention to the next slide. Now, before we launch ourselves into mega projects, let me also take a couple of questions, if you allow me. I see a couple of questions about zero liquid discharge and seawater desalination. Unfortunately, that is out of the scope of my coverage, but I will put in touch with someone from the team who can take on your questions about desalination projects. Obviously, we have an exhaustive database of desalination projects that MEED and MEED projects covers. What are the various sources considered for data gathering? Obviously, we rely on a network of sources from across the oil and gas projects market, based on both the client and contractor. And obviously, some of these project investments and forecasts have been issued by the operating companies themselves. Could you please share the list of foreign companies engaged in the construction of oil and gas projects? If I understand the question correctly, you are probably referring to either, it's the EPC contractors that you're probably referring to. Well, we've already shared a ranking of the top 20 EPC contractors currently in the MENA oil and gas market. You can explore the MEED projects database in greater detail. And yes, essentially, that should meet your requirement. There's another question about the ADNOC Fujairah project. Now, I'm not sure which Fujairah project the question is referring to. There are a number of projects in Fujairah that ADNOC is making progress with. If you were talking about the LNG project, like I mentioned, that has for now been relocated to Ruwais, and obviously the technical bids that have been submitted by contractors are based on that new requirement. Okay. It's time for tackling the mega projects that are currently underway in this market. Now, what is a mega project? It's essential to first set the standard for that. Now, our house view is that a mega project is a project that has a total allocated capital expenditure of $1 billion or more. And based on this definition, there are more than 230 oil and gas and petrochemical projects in the MENA region, either in execution or in different pre-execution or planning stages. Now, if we look at the the mega projects list, obviously we've only selected the top 20. There are, like I mentioned, 230, in fact, more than that, currently underway in the MENA region. But let's take a quick look at some of the top ones over there. The North Field LNG production project in Qatar, obviously that takes the prize for being the largest mega project at this point in time. Just the main EPC contract worth $13 billion, which was awarded to the consortium of Chiyoda and Technip in 2021, accounts for the single largest EPC contract to be awarded in the last 10 years, or maybe even more, in the MENA oil and gas projects market. There is a lot of interest in the Saudi Aramco and SABIC's liquid to chemicals program. Now, this is obviously, a lot of it is under the study phase, study or in FEED, in front-end engineering and design. And it's also important to bear in mind that the liquids to chemicals program encompasses Aramco's investments in sort of integrated petrochemicals and derivatives projects in the kingdom, as well as outside. Now, a bulk of those overseas investments will or are taking shape in China, some of them also in America. I think there is a project in Texas where Aramco is a stakeholder. So the entire liquid to chemicals programs, if someone were to put a ballpark estimate, that would be in excess of $50 billion. But in this chart, in the top 20 active MENA oil and gas petrochemical mega projects, we are looking at the ones that have been earmarked for the kingdom. And I would take some time in sort of explaining what the liquid to chemicals projects encompasses. And that's considering the interest we continue to receive in liquids to chemicals. Now, obviously, the main objective is converting 4 million barrels a day of Aramco's crude oil production into high-value petrochemicals and chemical feedstocks by 2030. That's the main vision. And that sort of is the mission statement for the liquids to chemicals program. It broadly, or currently, SABIC is focused on 3 main projects in the Russell Care area. One of them is the Russell Care Oil to Chemicals project. Now, I know this is a project that has seen several start-stop moments in the past, and that is mainly due to its cost-intensive nature. Estimates have suggested that it could be valued at somewhere between $20 to $25 billion. And that was mainly due to the unavailability of suitable thermal crude to cracking technologies, which sort of drove up those costs in the past. Several attempts have been made by Aramco and SABIC to, drive down those project costs. That include shifting the project from the initial location of Eastern Province to Yanbu on the Red Sea coast of the kingdom, and then back to Russell Care in the Eastern Province. A thermal cracking project is sort of the second component of SABIC's LTC mandate. And there is also a gas condensate splitter project that SABIC has been tasked with progressing. This is obviously the projects that have been planned for the Eastern Province and Russell Care specifically. Now, while these progress, the integrated Yanbu project on the west coast of the Red Sea coast of Saudi Arabia also is taking shape. Now, what is this project essentially? There was an MOU, a memorandum of understanding that was signed between Aramco and Sinopec of China in December of last year. And we understand that this MOU relates to a partnership for the planned integrated Yanbu project, or IYP, as is known in the market. And the proposed project calls for integrating the Yasref existing refinery in Yanbu with a greenfield petrochemical producing complex. So again, another great example of integration of refining and petrochemicals units. And obviously, there's immense feedstock advantage and cost advantages to be had from this integration. The Yasrif refinery has been an existing asset for a very long time. And integrating that will help Aramco, SABIC, and the foreign partner, which is Sinopec in this case, draw crude oil derivatives such as naphtha as feedstock from the nearby refinery and process that into chemicals. Okay, there are several other projects that are mentioned here. Obviously, I wouldn't be going into detail of each one. However, there has been a lot of buzz about the gas growth integrated project in Iraq. Obviously, we tend to stick a lot with the GCC, but the reality is Iraq has seen sort of a great resurgence with the planned investments that Total has committed to this GGIP mega project, as it is known. And obviously, it has seen the involvement of Qatar Energy as a partner, so that is added impetus for the future of this project. And the project that we've listed in the top 20 is just Total's investment commitment into this entire project. Obviously, the cumulative or the total investment that has been allocated towards GGIP by the 4 different stakeholders amounts to somewhere between $27 to $30 billion. The 10 billion is what has been committed by Total at this point. We also have the Upper Zakum expansion, again, a project that has stalled in the past, but is now seeing steady progress from ADNOC. Now, the Upper Zakum field is probably the oldest offshore asset in Abu Dhabi, and it is known to be the world's 2nd largest offshore oil field and the 4th largest globally. ADNOC Offshore initiated the UZ1000 project in 2019. And the reason why it's called UZ1000 is because the aim is to raise Upper Zakum's oil production capacity to 1 million barrels a day. The initial timeline was 2024, but obviously, considering only technical bids have been submitted by this point, you could expect the commissioning of the project to take place later in the decade, probably more towards 2027 or 2028. The ultimate goal from this project has also been upgraded from 1 million barrels to 1.2 million barrels. And the front-end engineering and design for this UZ1000, which in reality is UZ1.2 really, was awarded to Technigas Reunidas back in 2019. And like I mentioned, as per the latest update available to us, the technical bids were submitted in May, actually, and believe it or not, the commercial bid submission was actually scheduled for today, although in all likelihood that may have been extended as well. All right. I see a lot of questions have aggregated during this time, so allow me a bit of recess and take a look at what has come through in the form of questions. And again, may I also remind you at this point that this presentation will be made available to you at the end of this webinar, and the video recording of this session will come in your inbox later this week. What is the status of Aramco Master Gas Phase 3? We have a dedicated slide just on the master gas system, so I will come to that in just a short while. In Saudi Arabia, at present, what is roughly the ratio of oil and gas versus renewable energy? That is a very tricky comparison to make. Obviously, the objectives are sort of quite diverging. At this point, however, off the top of my head, if you ask me for an estimate, I would still say the share of oil and gas projects far outpaces the renewable energy ones. Obviously, that scenario will change as we go on into the next decade. Someone here has asked about more details on the military expansion project in Libya. A lot of that information is provided in the form of news on MEED.com and also in the form of projects database on MEED projects. A similar question with all the list of projects mentioned by you, how can we get the detailed status? All of this has been drawn again, as we've mentioned, as source from MEED projects and MEED.com, as well as from other secondary sources. So you'll find all of this information on our two platforms, MEED.com and MEED projects, as well as in a much more comprehensive form in the report that I mentioned right at the start of this webinar. All right. Now let's head to a snapshot of some of these mega projects. Now, before we do that, it's important to take a look at what exactly is influencing the national oil companies in the Gulf, as well as project operators in Iraq, in Iran, in North Africa, and in the wider region to commit to these increased levels of spending. We are already well aware of this, of the targets that have been publicly disclosed by the UAE. The target is 5 million barrels by 2027. It was 2030 before, but it's been brought forward to 2027. ADNOC has also announced a capital expenditure of $150 billion between last year and 2027. We've touched upon some of the projects where this 150 billion is going to translate itself. In Saudi Arabia, the maximum spare capacity target has been raised to 30 million barrels a day from 12 million barrels a day. 2027, Aramco in its recent second quarter results reaffirmed its spending commitment at between 40 billion and 50 billion a year. And this is each year. Kuwait, until the political situation stabilizes, it is difficult to take a view on how and where the project investments will be made. However, the targets that are in place are 4.75 million barrels a day by 2040 from 2.8 million barrels a day. Currently, Kuwait, bear in mind, is a very important oil and gas projects market. It is the third or probably the fourth largest in OPEC in terms of oil production. We have spoken about the North Field LNG expansion project. Now, this is to be achieved. Sorry, there's a typo mistake over there. The target is by 2027. So excuse the error over there. Now, the 126 million tons a year of LNG production is to be achieved in two phases, and we'll go into a bit of detail into that in just a while. This is to be achieved with the North Field East and the North Field South LNG programs. Market drivers, we have spoken at length about what exactly is funneling the billions and billions of dollars worth of investments into oil and gas projects at a time when there is a lot of clamor for the region, especially considering COP28 is due to take place later this year. To shift project investments from oil and gas into other segments of the energy market, specifically into renewables, into solar, into wind, and also nuclear when it comes to this part of the world. And while those investments continue to be made, we haven't seen a dearth of project investments in the conventional oil and gas and petrochemicals market. And that is largely due to the faith of governments and of energy companies in this region, that the energy trilemma requires them to keep up energy production at levels which can sustain mid to long-term demand. And based on obviously the supposition that oil and gas will continue, especially gas, will continue to be a dominant source of energy in the consumption mix for at least the next 2 to 3 decades. You can see some of the factors that we've mentioned as being market drivers into investments made by oil and gas operators in the Middle East and North Africa region, so I won't go into reading all of them. And now let's turn our attention towards some of the mega projects that we have attempted to list over here in detail. Now, I suppose there was a question about master gas system in Saudi Arabia, so I think I will jump to that first. And we've tried to obtain a picture of the entire pipeline network, the third expansion phase that has been planned by Aramco. What is this project really? Now, the original master gas system was built during the 70s and then commissioned in 1982. And that has been serving the kingdom really well. So it's one of the prized national assets in Saudi Arabia. However, over the past decade, amid rising gas demand from both industrial and household sectors, reasons for which we've discussed earlier in this webinar, Aramco has undertaken projects to increase its non-associated gas production and launched the second expansion phase of the master gas system in 2015. Arcad Engineering and Construction won the 3 main pipeline packages of MGS2 worth an estimated $1.3 billion in early 2016. And the EPC works on MGS2 were completed in 2021, which increased the gas handling and transport capacity of the master gas system from 8.4 billion cubic feet a day to 12.5. Was that enough? Clearly not. With rising demand from industrial and household sectors in the kingdom, the need was felt by Saudi Aramco and the government for increasing the capacity of MGS. And therefore, MGS Phase 3 was launched. This represents the third expansion phase of the master gas system. What is this project all about? Well, it involves the upgradation of the existing gas compression systems and installing of new gas compressors, which will obviously raise and increment the handling capacity of the entire network. More importantly, it involves the laying of over 4,000 kilometers of gas transport pipelines across various locations in the kingdom, as displayed in the map. I apologize, it's not of very good quality, but I think it broadly represents the main route of the expanded pipeline network. And you can see different corners of Saudi Arabia being covered, especially in the southwestern region along the Red Sea coast of Jazan and Shuaibah and Shakek, Jeddah, of course, Rabia, so many industrial projects being planned along the Red Sea coast, which requires a lot of gas-fired power plants to which the increased gas production will cater to. There are 17 EPC packages. Obviously, it's a huge project. And our estimate is the cumulative total of all those 17 comes around to $10 billion. Obviously, this is just an estimate. We will only know for sure once those contracts have been awarded, which we expect to be hopefully within the first quarter of 2024. And as per the latest information available with us, the technical bids have been submitted well during the course of last week and this week, with the commercial bid submission due for all 17 packages by the middle of September. We were talking about the North Field LNG expansion in Qatar, a bulk let's just say, the significant portion of North Field LNG, which has, the goal of which is to raise Qatar's LNG production potential from 77.5 million tons a year to 126 million tons through 2027, which may stretch into 2028, has been divided into the North Field East and the North Field South projects. Now, the strategic objective is to cement Qatar's spot as the world's top LNG producer and exporter, which is to be achieved in 2 phases, North Field East and North Field South. It was launched in 2017. At the time, obviously, it was the North Field East. North Field South followed, which essentially covers exploitation of gas in Qatar's North Field from the southern part of that giant reservoir. We mentioned the award of that giant $13 billion EPC package to Chiyoda and Technip in February of 2021. That EPC package mainly covers 4 8 million tons a year capacity LNG trains. So that would raise the North Field East package would raise Qatar's LNG production by 32 million tons a year. Several other contracts followed that year. The second package worth $2 billion was awarded to Samsung C&T from South Korea. That entailed the LNG storage and loading facilities. In August 2021, the third and the North Field East package was awarded to Técnicas Reunidas. That mainly covered the storage and loading facilities for condensates, propane, butane in the Ras Laffan industrial city. TR won a second contract in the North Field East project in a consortium with China's Wisen Engineering, which was a $600 million EPC contract for the building of sulfur handling, storage, and loading facilities. In answer to the question about consortium and JV splits, like I mentioned, where available, we do mention that and factor that in our project forecasts. North Field South, obviously, that is the second phase of Qatar's North Field East LNG project, and not of the similar value, but a mammoth one nonetheless. A $10 million contract was awarded to a consortium of Technip and CCC, Consolidated Contractors Company, in May of this year. And the main scope of work on North Field South is the building of 2 giant LNG trains of 7.8 million tons a year capacity. And this will ultimately raise Qatar's overall LNG production potential to 126 million tons by 2028. Técnicas Reunidas just a few days ago announced a third contract. This is actually their third in the North Field expansion program, worth $560 million for execution of EPC off-plot facilities for the North Field South. And again, the scope of work is very similar to what it had previously secured in the North Field East project. Now, we spoke at length in the past about integration of refining assets with petrochemicals. A prime and burning example of that is the Amiral Petrochemical Complex in Saudi Arabia, which obviously has been undertaken by SATOP, which is a joint venture of Saudi Aramco and Total Energies. You can see the joint venture structure being mentioned over there. What is this project all about? It's essentially a mixed feed cracker, which is capable of producing 1.65 million tons a year of ethylene, and also deemed to be the first in the region. SATOP reached the FID for Amiral in December of last year. Obviously, when I say Amiral, it's the petrochemicals part of the project, the central petrochemicals element that has been spoken about. There is several other power generation facilities that have been planned or due to be awarded by the end of this year, which again, MEED and MEED projects is covering intently. And the intention of this complex will be to provide feedstock to other petrochemical and specialty chemical plants in the Jubail industrial area, which will be built, owned, and operated by several other downstream investors. So those foreign investors have been envisaged to pool in another additional $4 billion worth of investments. SATOP has been successful in attracting investments in this Mineral Derivatives Park from INEOS of the UK. A Japanese firm has also committed to build derivatives units in SATOP. And obviously, a result of this investments is job creation, a lot of local and indirect jobs being created, a lot of value addition in the form of derivatives product lines being established in Saudi Arabia. And that essentially is the main thrust of the UMROS project. And now I would essentially like to bring the presentation to a conclusion by discussing the Hail and Ghasha mega project. We've very recently reported on the latest about this project. You can go and read the news story on MEED.com. I will not mention the front runners in the project. Obviously, a lot of that remains under discussion. A lot of those negotiations are still taking place. But what is this project essentially? Now, the Hail and Ghasha fields are located in the Ghasha concession, where ADNOC is a majority 55% stakeholder. There are obviously other foreign partners involved. And the main objective of the Hail and Ghasha project is to produce more than 1.5 billion cubic feet a day of SAR gas. It's essentially a SAR gas concession located in the Gulf's waters just off the coast of Abu Dhabi. The target is aligned with the company's broader goal of achieving gas self-sufficiency for the UAE by 2030. And what we are essentially talking about is the third EPC tendering phase. Previous two rounds have been revised, modified, and we are now in the third EPC tendering phase. And it started in April, just days after ADNOC actually canceled pre-construction service agreements that it signed with contractors in January. Now, those PCSAs essentially entailed the placing of orders by those contractors as selected contractors for long lead items. Essentially, a project of this size and scale requires a lot of forward planning, and essentially that is the reason why the PCSAs were signed with those contractors. But based on the estimates that came in from those two consortiums that were formed in January for the offshore and onshore EPC scope of work, it is believed that the estimates were far higher than ADNOC's total committed budget for this project, leading to a revision and a modification of strategy, and resulting in the third EPC tendering phase, which we are now witnessing. The contractors afresh expressed interest in participating in the latest round in May. We have heard from sources that ADNOC directly entered into discussions with bidders following that pre-qualification round. Like I said, we've reported on the front runners, so registered MEED users can go and read the information that we have been able to obtain. Like I mentioned, negotiations are still continuing and things are subject to change. And we believe those formal EPC contract awards to take place in the last quarter, with some even speculating a formal announcement could be made during ADIPEC in early October. Do not take my word for it. Before I actually take on some of the questions, and I have to apologize, we have run out of the scheduled time dedicated for this webinar, and I do not mean to keep you here for any longer. I will answer, or at least endeavor to answer, a bulk of those questions in detail, and we can obviously connect on a one-on-one basis. My contact details are mentioned in the slides, and please feel free to get in touch with me. And just a reminder about that, about the new MENA oil and gas report that has been launched. To take advantage of that, of the coupon code that has been made available to registered users of this webinar. It's only available until the 15th of September. And let me try and tackle a few, if I may. I don't see the $20 billion TASEES revised derivatives spark project in Abu Dhabi on the list. Do you have some insight here? Right. So it's, I mean, TASEES, obviously there are two phases that have been planned for the TASEES derivatives spark in Abu Dhabi. The first phase is obviously underway. The reason why we haven't collated all of the TASEES projects under one umbrella is because a lot of it is third-party foreign investments. The EDC, PVC project, for example, that is between a joint venture of Reliance from India with TASEES and Shaheen Chemicals of Abu Dhabi. So that becomes a separate shareholding structure and a different project operating entity. But we have been reporting on these projects, the latest one being the methanol project of Proman, the Switzerland company with TASEES. You can search the news website for the latest on that. There was a technical issue that happened. Could you let me know the Sinopec related project? I was referring to the Yasref integration project in Yanbu. The MOU was signed between Aramco, SABIC, and Yasref last year. And the ultimate plan is to integrate a greenfield petrochemicals producing plant with the existing Yasref refinery belonging to Aramco, and rather a joint venture of Aramco and Sinopec in Yanbu. Do we have time for just one last question? I think there's a question regarding the crude oil to chemicals Yanbu project. What is the expected execution? If I got that question correctly, the gentleman is asking about the execution schedule. Well, it is still early days to be talking about EPC execution when it comes to COTC. Obviously, it is still under the pre-FEED stage, if you may. And there's a lot of work that requires on the part of Aramco and SABIC to first establish the commercial viability of the thermal crude to chemicals technology. They'll have to do the math and calculations in-house about the kind of cost advantage that they will derive from converting crude oil directly into chemicals bypassing the refining stage. But progress continues to be made, and we will try and stay on top of it. Yes, there is another question regarding the North Field production sustainability compression packages C and D. Right, and also the North Oil Company's Ruya project. I believe both those projects will be awarded by the end of the year. Obviously, bids have been submitted for those packages, the Ruya project packages already. And the EPC contract awards may well be issued in the last quarter. The compression packages C and D, the very latest award was made to McDermott very recently. It's a $1 billion contract award that was also publicly announced by McDermott. Really? I really will have to make this the last question before the producer actually storms into the room and stops the session. What is the meaning of derivatives projects? Well, essentially petrochemicals that serve as feedstock are then converted into high-value chemicals, which are then used in everyday industrial and household usage. Detergent, for example, your regular use, washing powder. Things like the chlorine that is used in industrial usages, even to some extent the fertilizers. Now, you need the main petrochemical feedstocks of ethane, propane, butane, which then are processed further to derive these specific high-value sort of product lines. Essentially, what has happened for so long in the Middle East and North Africa region is it is a region that has always relied on exporting crude oil as it is, as a feedstock to its customers around the world. Now, as the importance or the demand for crude oil continues to diminish over time, the focus shifted essentially during the last decades towards deriving greater value from every barrel of crude they produce, and hence the push towards petrochemicals. And now what we're seeing, as someone mentioned in Taziz, a second phase has now been announced, which will witness the conversion of even more petrochemical feedstocks into new and specialized lines of derivatives. Now, with that, I will have to take your leave, but it has been a great interactive session. You could see at the peak, there were almost 500 people, if not more. So thank you very much for tuning into this MEED Live webinar. We will continue our series of webinars on oil and gas projects, as well as on other projects markets in the Middle East and North Africa region in the weeks and months to follow. So do stay updated on the schedule. And also, please do get in touch with me personally. It'll be lovely interacting with you, getting to know you, discussing more of projects, and sharing insights, really. Thank you very much for your time, and hope to see you around the next time.